right, so for part 3 of chapter 6, we're going to now look at reconciling the difference between the net operating income we found under the variable costing method and the net operating income we found under the absorption costing method. So that's a $30 difference, and we want to see where that $30 difference is coming from. Now remember, we initially, if we go back to the top here, we produced 25,000 units, but we ended up selling 20,000. So we produced 25,000 units and we sold 20,000 units. So in this case, the amount that we produced is greater than the amount that we sold. When that happens, when you produce more than you sell, you have leftover inventory. And that leftover inventory has costs associated with it. And those costs are sitting in finished goods until you sell those units, and it's only until you sell those units that the costs attached to those units are released onto the income statement in the form of cost of goods sold. So in this case, how much leftover inventory did we have? We had 5,000 units left over, or our ending inventory, to go into year 2 with. Now the question is, though, how we value these 5,000 units. It's different with variable costing compared to absorption costing. These 5,000 units, regardless of whatever costing system we're using, these 5,000 units we know have $10 per unit of variable production costs attached to them. This is for variable costing, and it's the case for absorption costing. But it doesn't stop there for absorption costing. Those 5,000 units left over in ending inventory under absorption costing, not only do they each have $10 attached to them of variable production costs, but they each of them also have $6 attached to them just for fixed manufacturing overhead incurred for the period. So we'll label that variable production costs. So I'll say that again. The 5,000 units that we have left over in inventory at the end of this year, because we produced 25,000 but only sold 20,000. Under variable costing, each of those 5,000 units only have $10 per unit attached to them under variable costing for direct materials, direct labor, and variable overhead. But under absorption costing, not only do you have those $10 attached to each of them, but you also have $6 of fixed manufacturing overhead from this period attached to them. Now under variable costing, what happened? Under variable costing, all of the fixed overhead we incurred for that period, all of that was subtracted out or expensed out in the period to give us the $90,000 net operating income. But under absorption costing, remember first we attached all 150,000 of that to all 25,000 units we produced. So those 25,000 units, they are what is attached, or the other way around, the fixed manufacturing overhead rather, is attached to those 25,000 units that we produced under absorption costing. So remember we said for a cost to be released from inventory or from finished goods, we have to sell them. So when we produced those 25,000 units, not only did we attach the variable production costs to them, but we also attached the fixed manufacturing overhead from that period to them, $150,000 of it. So that $150,000 of fixed overhead, along with the other production costs, but we're talking about fixed overhead here, that $150,000 of fixed overhead was put into finished goods. But not all of that $150,000 of fixed overhead ended up flowing through to cost of goods sold, because we didn't sell all of the units that $150,000 is attached to. How much of that $150,000 actually ended up flowing through to cost of goods sold? Well, you can figure that out. Remember, we only sold 20,000 units, and each of them have $6 of fixed overhead attached to them. So $20,000 times $6, or sorry, 20,000 units times $6 a unit That's $120,000 of fixed overhead of the 150 that actually ended up in cost of goods sold for the period. That means that in finished goods, not only did you have direct materials and direct labor and variable overhead attached to those 5,000 units remaining, but you also had $30,000 of fixed manufacturing overhead from this year still sitting in finished goods. Because remember, we said only 120,000 of that 150,000 actually end up going to cost of goods sold because we only sold 20,000 units of the 25,000 that we made. So it's this $30,000 that is in fixed overhead that's still stuck in inventory under absorption costing that is responsible for the difference between this $90,000 net operating income under variable costing and this $120,000 operating income under absorption costing. So this $30,000 still stuck in inventory, that's what we would call fixed manufacturing overhead deferred in inventory. So it's actually not going to flow through onto the income statement in the period in which it is incurred, that $30,000, because remember, the $150,000 overall was attached to those 25,000 units we made. And since we only sold 20,000 of those units, only 20,000 units times $6 is the amount of fixed overhead that was actually taken out of inventory and flowed through to cost of goods sold. So that other 30,000, that other fixed manufacturing overhead, $30,000 of fixed overhead cost from this year will be deferred to a later period. And when will that $30,000 eventually flow through to cost of goods sold? When those 5,000 units left over are eventually sold. So how do we set up that reconciliation? So let's do the reconciliation down below. So we're going to reconcile the two amounts. So we're going to start with our variable costing, net operating income, and that is $90,000, which we found up above. Now, we want to reconcile that with the absorption costing, net operating income, of 120,000 because the amount sold is different from the amount produced for the period. We're seeing different net operating incomes between the two methods here. Now, how do we get from 90 to 120? Looks like we're going to have to add 30,000 here to get us to 120. Well, what are we going to label that 30,000 as? Remember, we said from our discussion a couple moments ago that that is going to be what we refer to as our fixed manufacturing overhead cost deferred in inventory. So $30,000 of that fixed manufacturing overhead is still stuck in inventory under absorption, so it never flowed through to the income statement, which means that we didn't subtract as many costs under absorption costing as we did under variable costing, which leads to a higher net operating income if you're subtracting out a smaller amount of costs versus variable costing. Whereas under variable costing, remember, we subtracted out all 150,000 of the fixed overhead because we see it as a period cost. So we subtracted all of that. None of that 150 was deferred, which led to the smaller net operating income at the end of the day. So that's what the reconciliation looks like when we compare variable costing to absorption costing. And again, where is that $30,000 coming from? Well, we have 5,000 units deferred in inventory or left over in inventory. And each of those 5,000 units, under both systems, those 5,000 units have $10 of variable production cost attached to them, but under absorption costing, each of those 5,000 units have an additional $6 per unit attached to them just for fixed manufacturing overhead incurred for the period. So 5,000 units times $6 of fixed manufacturing overhead per unit gives us a total of $30,000 of fixed manufacturing overhead cost deferred in inventory. So we're going to pause here, and in the next video, part 4, we're going to extend the comparison and look at a second year of operations.